$113.05 billion in revenue, $43 billion in AI backlog. While everyone is busy chasing the hype around new players, this legacy giant, Dell Technologies, just dropped one of the strongest earnings reports in its history and made it very clear who the real infrastructure king of the AI era is. This isn't just an earnings beat. This is a textbook display of cash flow dominance and market control. What's up, guys? Welcome back to Deep Dive Stock Earnings. If Supermicro is fighting for growth at all costs, then Dell Technologies is the one quietly harvesting the battlefield with raw execution. A lot of people think Dell is too old, too slow for a but after this video, you're going to see something very different. This giant didn't just wake up, it's starting to take over the game. And the smartest part, Dell isn't just riding the AI wave, is crushing the legacy business at the same time. Dell went absolutely off in fiscal 2026, delivering the highest annual revenue and EPS in company history. $113.05 billion in revenue, up 19%, pushing the ceiling even higher. But what really shocked Wall Street was the cash flow engine over at $11 billion in operating cash flow, with $7.05 billion returned directly to shareholders. This tells you something important. Dell isn't just making money on paper, it's stacking real cash. This is what separates a heavyweight from the rest in the U.S. market. Revenue growth is the headline, but cash flow and buybacks are the real story. Dell returning $7.05 billion means one thing: they're not short on cash at all. And when EPS is growing at 27% faster than revenue, that's classic operating leverage. At that point, you're no longer just a hardware company, you're a profit machine. AI has gone from a side business to Dell's core growth engine, and the power behind it is massive. $64.01 billion in AI orders for the year, with over half of that coming in just Q4 alone. That tells you demand is accelerating fast. And it gets even crazier. Dell's AI backlog is now sitting at a record $43 billion and still growing. Their AI customer base has surpassed 4,000, ranging from sovereign nations to enterprise giants. Look at the quality of that backlog, $43 billion. That means even if Dell stopped taking orders tomorrow, they've already locked in the next 2 years of revenue. And here's the key difference: while companies like Supermicro rely on a few mega clients, Dell has over 4,000 customers. The diversification massively reduces risk. A lot of people worry that AI will cannibalize traditional servers, but Dell's data proves the opposite. Traditional x86 servers are actually entering a strong upgrade cycle, with demand outstripping supply. By upgrading from the old 14GS platform to the new 17GS platform, customers can replace 7 machines with just one, cutting both power usage and cost significantly. And in the AI ecosystem, traditional compute is still essential for data pre-processing and orchestration. This is where Dell plays it perfectly. It turned what could have been internal competition into a double win: high-margin legacy servers are now funding the expansion of AI infrastructure. That 7-to-1 consolidation ratio is insanely attractive for enterprises. It saves power, space, and money. Dell's logic is simple: whether you're doing AI or not, you're still buying Dell servers. In storage, Dell is fighting back with its in-house IP strategy. High-end all-flash systems like PowerMax and PowerStore have delivered 3 consecutive quarters of double-digit growth. As more of Dell's storage stack becomes proprietary, it's offsetting rising memory and component costs. Storage has become a stabilizing force for margins. In hardware, the worst position is being just an assembler because suppliers take all your margin. Dell avoided that trap by building its own storage tech mode. The more PowerStore they sell, the thicker their margins get. That's how they're beating cost inflation and still delivering strong EPS. In the ultra-competitive PC market, Dell took an aggressive approach. Q4 CSG revenue grew 14%, gaining market share to lock in key customers. Dell even delayed price increase in sacrificing short-term margins for long-term positioning. Once pricing adjustments were implemented in January, profitability quickly recovered. This is classic capture land first, monetize later. Dell used its cost advantage to clean up the market, locking customers into its ecosystem before raising prices. That strategy only works if you have scale, and Dell definitely does. Now they've got both the market share and the margins back. Looking ahead, management is extremely confident. Dell raised its guidance, projecting revenue to reach $140 billion next fiscal year. AI server revenue alone could double to $50 billion, and on top of that, they announced a 20% increase in annual dividends, sending a strong signal about future cash flow strength. Doubling AI server revenue to $50 billion, that's basically building another super microcomputer in size. And a 20% dividend hike means management is very confident in cash flow. Dell isn't selling a dream, they're sitting on real demand and real money. Very few companies can combine AI growth and shareholder returns like this. On the technology front, Dell is already preparing for the next wave, transitioning from NVIDIA Blackwell architecture to the upcoming NVIDIA Vera Rubin platform with years of manufacturing and deployment experience. Dell can execute quickly. Deliveries for Vera Rubin are expected to begin in the second half of fiscal 2027. In AI, execution is everything, and this is where Dell dominates. They've seen every problem, solved every bottleneck. That's why they're one of NVIDIA's most reliable partners. When new chips drop, Dell is always first to ship. Even with rising component costs, Dell shows strong resilience. Through short quote cycles and dynamic pricing, they pass costs to the market. More importantly, with solutions like PowerStore, they use data reduction technologies to deliver higher capacity with less hardware, protecting margins while saving customers money. To sum it up, Dell right now is both rock solid and incredibly fast moving. It has steady cash flow from legacy business and explosive growth from AI. It can handle supply chain inflation and still return massive capital to shareholders. So the real question is, can Dell's all-around strategy crush pure-play AI server companies in the long run? Drop your thoughts in the comments. This is Deep Dive Stock Earnings. I'll see you in the next one.